Hello and welcome into the KE Report. Shad and Corey here, getting an update from Nick Hodge, co-owner of Digest Publishing, and editor of Foundational Profits and Hodge Family Office. And Nick, it's always great to get you on the show once a month just to talk markets, looking at the macro, looking at the micro. I guess we have to kick things off today with the Fed. The FOMC meeting is today. We know we're going to get a cut. We just don't know if it's going to be 25 or 50. We were talking off mic that really it's the beginning of a rate cutting cycle, and there are some people that have a bee in their bonnet about this. I'd like to have you weigh in on it because we don't know what it's going to be quite yet. But either way it goes, what are your thoughts on the beginning of the Fed rate cutting cycle, Nick?
I haven't heard bee in a bonnet in a while. We keep bees. And yesterday, my wife had a yellow jacket in the hive, and I guess that's a bad thing. Maybe the new saying should be a yellow jacket in your beehive. Apparently, the honeybees don't like that. We've known that the Fed was going to cut for several months now. The market started pricing in rate cuts months ago. And, even a month ago when I was talking with you gentlemen, I was talking about, the only sort of question, is it going to be a 20 or 50 basis point cut? You can go back and play the tape. That was 30 days ago. And of course, us being a Fed-centered financial society over the past 48 hours, that's all anyone has talked about, right? 50 or 20, 50 or quarter, 50 or quarter, et cetera. Doesn't really matter. What it's been is you're going to get a rate cut, and all the major macro indicators have telegraphed that, right? And, the two-year yield has come down precipitously. 10-year yield has come down. Dollar has come down from 105, 106 earlier in the year to 100 on the DXY index. So this is the most telegraphed Fed rate cut of all time. And in many ways, it's already been priced into the market, not just in terms of the CME Fed Watch tool that everybody clicks on to see what the probability is, but in terms of rate sensitive trades and gold, right? I mean, a month ago, gold was at 2,400. And I was saying that in a soft rate environment, you're going to wake up one day and see 2,600. Well, we've already waken up and saw that. And then put on your memory caps to a month ago when the S&P was crashy and the VIX spiked to levels not seen since 2008 and 2020. And we were wondering if this was the beginning of the end of the world, as some people were saying. And I was saying I'm not sure that's going to be the case, and here we are. The S&P is back at all-time record highs, but what you've seen is a rotation, and we were talking about that as well. Nvidia reported earnings and did not meet expectations despite the spin headlines that you may have read. That stock has been down since the middle of August or even before when it reported earnings, and the same is true for sort of the Magnificent Seven, as it were, right? I've seen headlines on my daily newsletters like the meh seven, for example. It's a far cry from Nvidia being responsible for 20 to 30% of the S&P's move in a single day, leading it to new highs. Now you've got more of a normal, balanced, and dare I say, resilient market, as new sectors have come to lead it to highs in the past month. The ones that I was telling you would be the case, in fact. Like, if you looked at the sectors of the S&P, the 11 of them over the past 1 month and 3 months, you'll see that REITs, utilities, staples, and financials are now leading, and the former leading sectors like communication services and information technology are sort of the lagging sectors over the past 1 month and 3 months. And the other thing, at least psychologically, that I pointed out last month was Warren Buffett dumped his Apple shares. That's a pretty significant shot across, let's go with the golf course, for people who are interested in following one of the most famous and successful money managers of our lifetimes, right? This gentleman is rotating out of tech, and I'm convinced that that's going to be an ongoing rotation back towards the things, again, something I've said before, that you can drop on your foot and have value. But for now, we're sort of in the eye of this transition or this rate turnaround, right? Where we're going to get our first cut in a couple of years after 40-year high inflation, and we sort of just have to read and react and see what comes after this. As far as 20 or 50 basis points, that ain't me, babe. You won't find me pulling out my hair on TV debating that.
So, Nick, has this shift away from tech into some of the more interest rate sensitive sectors, is this sustainable? Is this a long-term trend that you think investors can, in a sense, buy and hold, because we will be getting a series of rate cuts well into next year?
Well, buy and hold might be dead. I grapple with that. A long hold period for me seems like is 3 to 6 months now. And I'm thinking to back when I first started going into these rate sensitive trades. I think it was, well, I don't have to think. Like, I started buying utilities in February, and I started buying REITs in May. And one of those REITs, it was up like 75% since May when we started buying it, and we sold it last week, right? What is it, the middle of September? And so to answer your question more succinctly, what we did is we went and bought another REIT, right? That we rotated inside the REIT space that hadn't run as far as hard yet. And so, yeah, I think it is a bit more sustainable, right? I don't think it's going to be one and done. Certainly, if it's a quarter point cut, I think you get more post-election. In fact, if you're forcing me to decide, I would say that I don't think the Fed, and particularly Trump appointee Powell, wants to be seen as meddling in the election. So perhaps we do a quarter point cut, and it leaves the room for more post-election, no matter who the next president of the United States is. But nonetheless, yes, I think it's you asked if it's sustainable. It's more normal for sure. I mean, you don't need, and it shouldn't be 7 companies that are powering the entire S&P 500 higher, right? It's not the S&P 7, it's the S&P 500. And so to get some rotation into these other sectors, not just REITs, not just utilities, but staples, as I said, are doing okay financials. That's sort of a more balanced and resilient market, and something that seems more normal. And yeah, we'll see how long it lasts. Like, I think, looking into my crystal ball, I think growth continues to sort of middle along, stays in this 1% to 2% range. I think oil's been soft over the past couple of months. Brent put in a 70 handle for the first time in something like 2 years. Copper came down from 5 to 4. And so that'll be reflected in this month's and next month's inflation data, which are going to be soft, right? Like 3% inflation, perhaps a 2 handle on inflation. And then I think you'll see that reaccelerate into the next year, where the Fed might have to either reverse course or say that it didn't do the right thing. And so when you ask if that's a sustainable thing, I'm not sure, because the world has been so crazy. The markets have shown that they can get volatile really fast, and it's more a thing of we got to see what the data is going to be and then interpret it faster than the Fed does and makes their next decision. So for the time being, to stop the verbal diarrhea and to just tell you what I'm doing, because I find that's the easiest way to answer questions. Yeah, we're still in a large percentage of cash, a large percentage of gold. And after cash and gold, our biggest holdings would be REITs and utilities. And I don't think that's going to change in the next 48 hours.
Well, Nick, when you think about those categories, a lot of people would say that REITs or financials or utilities and even consumer staples fall into the defensive style things, so maybe the value side of things. You'd also mentioned for the commodities and industrial side of things that could drop and fall on your foot, so hard assets. Do you think that there's going to be more of that change from runaway growth and tech stocks and maybe more into the value sector?
Yeah, absolutely. I mean, that's another way to phrase it. So again, and look at GDP and look at the advent of AI. So, you had GDP with a 4 handle on it. You were coming out of a global lockdown, like 2021 and 2022 were boom times, and you had a very fast and real expansion of technology. I mean, that chip shortage was real. The rush to Taiwan Semiconductor and NVIDIA, that was real. Like, their revenue growth was real. And I think that's starting to slow now. Like, they didn't hit their future guidance. That's what people were disappointed about when NVIDIA reported earnings a couple of weeks ago. And I mean, let's just take that narrative. Let's just take that tech AI sort of chip narrative, right? So just for the sake of argument, assume all the chips have been bought, right? That the demand is going to start now to level out on the chips. Well, the thing that us, mining investors, mining supporters, the mining interested, the people who, invest and watch the commodity and resource side of things have always said is, great, but how are you going to power all these data centers, right? Like, where's that going to come from? And then you can take that a lot of different ways. Primarily, it goes to copper and nuclear, right? And just this week or last week, you had Oracle come out and propose data centers that are, built from inception with mini nuclear reactors powering them, right? And then you have, I don't know if it was Goldman or some other bank this week, come out and augment their long-term copper forecast because of, how much copper is going to be needed to power data centers. And it's like, yeah, cool. That's a new report this week. But, I've known this for 5 or 10 years, right? Like, this has always been the long-term case for commodities and resources. Like, yeah, good luck cleaning up the environment. You're going to need $150 uranium. Like, good luck electrifying everything. You're going to need $5 to $7 copper. And it's been tough for the past. Choose your time frame, right? And commodities are cyclical, and it's a capital intensive business. But the long-term trajectory is falling into place accordingly, right? Based on some of the things that I just said. You had a great run in tech, and now you got to power and build all these data centers. And the people who are doing that are looking to the resource base, as I just evidenced with Oracle. I saw another article come out in the Bloomberg recently about the sheer volume of things that were going to be needed for this electric future. And it was sort of a misnomer, right? Or a non sequitur, because it was talking about it was comparing the tons of coal to like the tons of cobalt and steel and silver will need, but it was just comparing the tons of coal to the amount of steel. It wasn't talking about the tons of ore that have to come out of the ground to get that amount of steel and copper and uranium or whatever it is, which is something that, no one understands. And so I think I'll pinch it off there because I'll start talking about how long mining takes and, the fact that the Goose Mine is about to go in production up in the Northern Territories, and it was discovered over 30 years ago, man. And so some of these rotations take time, but to get back to the question, yeah, it's a rotation from that fast growth, from that Nvidia being a penny stock back to that more sustainable 2-3% growth. That's not a recession, but is going to need ultimately the commodities to build the things that we've already written the checks for.
Let's go down that road of just how long it takes for mines to be built on the back of that whole argument that, yes, we do need more of these materials, but we also hear that, oh, we need more discoveries. We've made less and less discoveries over the last 5 or 10 year period compared to the 5 or 10 year period before that. And then even before that, the problem is we can make these discoveries, but they don't get brought into mines. So from the investment angle, Nick, is there still some enticement for you to get into these new discovery plays, or should investors be focused more on these assets that are known that need to get built to satisfy this demand?
There was a time in my career where I really like the developers, and what I've learned is what we're about to talk about. They always take longer and they cost more, and the NPV can be great and the IRR can be great. But that doesn't necessarily matter if they're issuing shares all along the way and to get through the PEA and the PFS and then the permitting, et cetera. And then you end up with a larger market cap, but, hundreds more millions of shares out, and your gains are, non-existent, right? Because you've been diluted out. So, and I see that going on with some of these developers that have taken time. So, maybe it's just taken me time to learn lessons that everybody else knows, but it's, part of it, is the Lassonde curve, right? Like, well, let's just look at companies that I'm involved with, like Perpetua, for example. I've been involved in that company for over 10 years, and since 2013 or 2014, and it's always been a 6 to 12 million ounce gold asset in a U.S. jurisdiction with a critical antimony byproduct, right? And that was true in 2013 and 14 and 15 and 16 when it went into permitting, and 17 and 18 and 19 and 20 and 21 and 22 and 23, and also this year, 2024 of our Lord. The deposit never changed, but we had NGO lawsuits, and we had to deal with the Forest Service, and we had to deal with the EPA, and there's things that swim in the water that runs through that property. And it's so, it comes all the way to a decade later. And here we are, back to my point about where are these things going to come from, until all of a sudden you have the Department of Defense giving this company $75 million before it's even approved, because they're so desperate for the antimony. Forget the gold. They want the antimony that China just said they're going to curb the exports of last week, right? And so you have U.S. government departments throwing money at this project even before it's got its final record of decision. And so back to your question, yeah, it ran on the discovery. It had periods where the stock did well when Barrick came in and took 19%, et cetera. Those things are sort of hard to forecast, when those catalysts are going to happen. So yes, you need to be in on the discovery, and then you need to be in at the end. Lobo Tigre has written a lot about this, buying companies that are, getting their permit and on their cusp of bringing a mine into production, sort of that end of the Lassonde curve. The middle can be really mucky and can take a decade or longer, as I just laid out for you there. And so as a speculator, and even me, one that continues to be educated and learn from mistakes, and then sometimes in real time here as I'm formulating my answers to you, it seems like that early discovery is still getting a pop, and will always get a pop, right? Because you're going from an entity that didn't have a resource or discovery to something that does, and there has to be a re-rating, and then coming back in on the end of that curve. if you can keep tabs on it, because a stock like Perpetua that was, I don't know, $4 6 months ago is $12 today, right?
Well, Nick, it brings up an interesting point about the importance and, like you say, that pre-production sweet spot that Lobo Tigre is highlighted at the end. But that's usually once they're getting the permit. A lot of the pop in Perpetua was that they got that environmental permit, that fine or that plan of operations, and so I didn't realize how important permitting was until the last couple of years in this business because initially it was like the project, the people. That's what everybody were talking about. I think we need to be talking about permitting because there's a lot of great projects out there that have been on the vine waiting and waiting. And some of them at Beaver Creek, when we were all just there, I started off the interviews with like, hey, I don't want to hear about the project or the drilling or management. I want to hear about where are you at with permitting. And I started a lot of interviews that way, and they'd have to jump through their slide deck to the very end. I was like, because honestly, if you don't have some of the key stuff in place or what the timeline is, what is the value driver for your company in the meantime? Because you're just going to be sitting in that orphan phase. So, how important is it for investors to start asking those kind of questions of management teams?
It depends on where you're at in the life cycle. I mean, again, if you're going for a discovery and you don't have a resource yet, then those sort of questions are further off because you can get that initial pop on the stock from the discovery. But yeah, if you're talking about a resource, a development story, then those questions are ultimately important, right? Obviously, you have people who say they look for the fatal flaw, and for some investors, if you can't get your project permitted, or there's a chinchilla, or there's an indigenous population, or whatever it is, some of those are fatal flaws for certain investors. What's more interesting, and I don't know how to tap dance around that, right? I don't know how to say, this project is going to have, I mean, there's obviously some things you can look at, where it is, the communities around, legacy permitting, the scores of its jurisdiction by, third party consulting firms, all that sort of stuff. But so here's what I want to talk about more. You can get lost in the minutia of that. I think what we've done as a society, and I'm going to give you a bit of a non-answer here, but it's something that I've been thinking about is, we've gone so far down the ESG path that we've tied ourselves in knots on the easiest solutions, right? Like, oh, you don't want emissions? Well, excuse me, I'm going to cuss. Fucking build some nuclear plants, right? But you can't, right? Because then there's environmental opposition to that. And we've got to talk about the nuclear safety and this, that, and the other thing. And I think it just doesn't affect mining and energy assets. It affects all kinds of stuff. Like, there's a bridge that collapsed in the Baltimore Harbor a couple of months ago. And I was doing some reading on how long it took to build that bridge initially and how much capital it took to build that bridge. And conversely, how long it's going to take to rebuild that bridge, right? And it's going to take much longer to rebuild it than it took to initially build it, right? Because there's going to be a non-government organization who sues, and there's going to be some oyster that they find when they pull up one of the pillars from the footing of the bridge that they're going to have to do a study about. And then there's going to be some other thing, and then there's going to be some other thing. And I know this is a bit philosophical and esoteric, but partially that's, what's been the malaise and the detractor from the mining industry. It's like, well, why would I invest in this project if it's just going to be tied up in permitting for 10 years, right? That's dead money. And in some respects, that's out of our hands, but it's something that needs to be corrected to make the space viable again. And you've had a government, not just the US government, but European governments all down the line, Western governments, who talk out of one side of their mouth calling for more stringent emission reduction targets, higher EV production and sales targets, and they just pull these things out of the ether without realizing the resource inputs that need to be extracted from the earth to make it happen. And when you tell them, hey, we got to mine some uranium to meet this target, or we got to mine some cobalt or mine some lithium, they don't want to hear it, right? Because there's a chinchilla on the mountain where you need to get the lithium out of. I mean, what's the saying? You can't have your cake and eat it too. You can't say to the world, you've got to build more batteries, and at the same time, not approve the mines that have the resources that you need to build the batteries. And so I think we're working through that. I think governments are starting to realize, they always realize too late and then try to course correct. But again, back to Perpetua, that's a great example, man. Like, there is no other US domestic source of antimony. And if you want to build missiles to bomb people on the other side of the world, which the US loves to do, then you're going to have to build this mine.
So, Nick, I guess one other comment regarding how investors are positioning within the resource stocks. As much as we talked about the broad markets, everybody piling into tech, it feels like within the resource stocks, there is this dedicated group of people that invest in them and they can move from one commodity to the other. It wasn't long ago that lithium was running, uranium was running, and now it really seems to be investors are focused on gold. Gold's running and the big time gold stocks are running. Do you play any of these shifts in sentiment where once one metal goes out of favor, another can come into favor and those stocks can really run? Or right now, is it simply a gold market? So focus on the gold stocks.
The answer is yes, but I do it more from my macro screen. So I'm not doing that with juniors. I'm not like rotating out of my penny stock lithiums into my penny stock golds or whatever. I sort of have those as long-term speculations. And I've told you guys that over the years. I take positions and I write checks routinely in future rounds, et cetera. And then I trade around positions. So the answer I'm going to give you is more for macro, and I'll give you a specific example. The answer is yes. I was telling you guys in February that I thought copper was going to run, and we were going into copper ETFs that held companies like, Freeport and BHP, for example. And I use those as sort of prodding attacks, is what James Dines called them, and that allows me to be in a liquid vehicle that I can sell if things turn. And guess what, Corey? We've sold that copper ETF, right? Copper went above $5. It's had a rough past couple of months. We sold it after the peak. We made money, but we're not in any large cap copper miners at the present moment. Could we go into a different ETF for a different metal? Sure. I mean, we do own GDXJ, and we do own GLD, so we are in those sort of flavors of metals. But yeah, if lithium starts to run again, we'll buy LIT. Sure, why not? And I think that's another thing that feeds into the lack of long-term investors in the space, right? It used to be you had an audience, people that love gold and resource stocks, and they invested them throughout their, investment life cycle. Now, with the advent of many things, with the advent of ETFs, I think I forget how many thousands ETFs there are now. There was only a couple of hundred in the 2000s, right? There's an ETF for everything, even options call strategies on specific sectors, right? So you can buy an ETF for everything. And by the way, you probably got a phone in your pocket or sitting right in front of your desk. You can trade from everywhere. And these are things everybody knows, but sometimes you just need to stop and meditate on them, right? And the other thing is, since 2020, everybody's a trader, right? Everyone's a bettor. Look at just stocks like Flutter and MGM and DraftKings. And if you're not betting, you're investing, which is essentially the same thing, right? AMC and the Reddit meme stocks and all that sort of stuff. So even retail investors that used to sort of stick to their knitting, they're content going all over the place, right? You've got Wall Street Silver, you've got people who are on the tech space, and they're content to rotate as well, because the last point I'd mentioned there is the zero commissions, right? It doesn't cost you anything to change around. You take out your phone, you press a couple of buttons. I'm out of the copper ETF. I'm into the silver ETF. It cost me zero commissions, and it took me 30 seconds. And so all those things combined are why there's flavors of the month. And back to your question specifically, yeah, I do it with the macro ETFs for sure.
Yeah, and I think that's a good point. I think there is more of that passive investing style, or with an ETF, you're buying a basket, you're buying a sector. You don't have to do all the intense due diligence on the individual companies and try to build your own portfolio. You can simply buy an ETF for most spaces. But Nick, you also still, as you mentioned, position in the early stage juniors. You write checks to companies. And one that we've talked about in the past is Hannan Metals. It's a copper, silver, gold explorer. And you were just on a site visit in Peru. So also bring in that angle that while you may play certain sectors and change based on the macro that you see, on the micro side, you still invest in individual companies when you like the projects and the people. So maybe give us an update on your site visit to Peru.
Yeah, for sure. And that's a great segue. And just one sentence to bridge the gap from the last thing I was talking about. The market doesn't trade as much on fundamentals anymore. There's lots of good reading out there, but it trades more on price action, volatility action, and call and put buying, option buying, right? You've read, I'm sure, about these 0-date expiration options. And so the market just fundamentally changed in the past quarter of a century, where, PEs and earnings don't matter as much. They simply don't. It's more about the flow of the market and the price action and the options that dictate the buying of the algorithms. And so yeah, that's why I gave you that last answer. And that's why people do more of that sort of short-term passive into the ETFs for all the things that I just laid out. I mean, the market has just fundamentally changed. And so tying it all together with Peru, Yeah, Hannan's a company I've been involved in for a long time. I mean, I was first writing them checks when they were drilling for zinc in Ireland, right? And now we're on to a really big discovery in Peru. And so I'll try to tie together a bunch of things we talked about today. When you talk about projects and people, like those still do matter. Like people matter. They've got to be able to pivot if you're talking about, a long-term junior life cycle, right? They've got to be able to bring in new projects. They've got to be able to raise money, all that sort of stuff. So people do matter. And then, zinc in Ireland didn't work out. They had this land package in Peru that they had for a number of years. And what happened is that it used to be a prime cocaine growing area. And I witnessed some of the remnants of that while I was, traversing the jungle on our tour. And the government has come in the past couple of years and basically tried to eradicate the coca growing, really cracked down on the coca growing. And so what's happened is that it's opened up the area to potential mining, to go in there and explore. And Hannan had the ground. In fact, they're a top 10 landholder in the country, up there with, some of the big international mining companies. And they went in and they started doing early exploration on this land, right? Looking in the creeks, looking at the soils, and they've made multiple discoveries. I think they're up to 14 or 17 porphyry showings, and that's just on one project. And you've got rocks, I was calling them Smurf rocks. I mean, they're just blue at surface. They're grading 12 to 15% copper. And then there's even disseminated gold in the soils, right? Like this is going to be a discovery. It's taken 2 years to permit. They've got permits for a certain section of their property that will be drilled this fall, and hope to get permits for the really juicy stuff later this year that they can then drill. And so, talking about all the things that we've talked about in the past 30 minutes, I think it's going to be a pretty big discovery. The market seems to think so too. Tech has come in and taken 9 or 10%. Japan's national oil and gas arm, which is called JOGMEC, has got a $35 million US JV on just a portion of the land package. And it all looks very real. Shares are up to 60 cents. They're at 52-week highs. Sprott wasn't able to get in on the last financing because essentially me and Gerardo took it all. And so you've got people out there buying in the open market, and they're going to poke a hole in the ground, and it's going to be a discovery. Is it going to be a mine? I'm not sure, Shad and Corey. And so that's sort of what we've been talking about. A big discovery out of Hannan in Peru could be a sell event for me, right? Because, I was there. I talked to the local communities. It's on the cusp of the Amazon jungle. There are local communities. They say they want the mining because they can't grow the coca anymore, but I don't know, pictures of banana trees don't really look great in mining photos. And so this could be a case where, we're out on this discovery. I'm not sure yet. I got to wait and see how it pans out and plays out. But it is going to be a discovery, and it is going to be exciting. And I guess last thing I'd say is I've made money over the years with Hannan, despite the failures, because you get runs in the commodity and the resource world that lift all boats or make all turkeys fly. And if you approach it like I do, where you have a select handful of companies that you work with for a long, long time, you get in tune with how they trade, and you can trade around your positions. So I've had success with Hannan, bottom line success, even though they haven't made a big discovery yet. And I'm pretty sure they're on the cusp of doing so, considering the 15% mineralized copper boulders that are just right on the sides of the creek there.
Well, it's an interesting update, and appreciate you kind of showing where you're looking at it as far as the different stage the company's at and where you may have a potential exit, but also discoveries still get a bid, and it can still be an exciting time in the life cycle of a company to go out and find a new project and make a discovery. It's been fun, Nick, just talking about everything on this call, the macro, what you're seeing from the Fed all the way into the markets and all the way into the commodities. And if people like what Nick has to say and want to follow along with his work, definitely click on the link below. It takes you over to Digest Publishing, and you can see all the different services that he and his partner Gerardo offer to readers in the different sectors. And Nick, as always, looking forward to our next conversation.
Appreciate it. If it's not fun, you shouldn't be doing it. So hopefully you guys are having fun as we talk about all this stuff.